taking profits in certain leveraged options positions, of which we have very, very few. And it turned out to be a good decision. I didn't know anything. I didn't know that gold and silver were going to fall imminently. Figured it's not making me comfortable to have that sitting there when the expiration to those options are pretty close and anything could happen by then. I might as well just take profits now. And that's what I did. Why is gold crashing? Why is silver crashing? They want to know what the proximate causes are. They want to know what the exact movements are that are causing the metals to go down in dollar terms temporarily for now. There are several approaches I could take to this. I could say, oh, market manipulation, everything's being manipulated. It's the big banks. They're trying to keep the gold and silver prices down so they can keep the fiat monetary system and the blah, 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 floating, blah. Or I could take the really dorky move and try to analyze exactly why the move from the COMEX into the LBMA caused the gold and silver spread to narrow and blah, blah, blah. I would sound really smart. And those who thought that I knew what I was talking about would say, wow, I know everything.
In today's news recap, gold price consolidates below $4,000 as the Federal Reserve cuts interest rates. The gold market is bouncing around $4,000 an ounce as the Federal Reserve lowers interest rates in line with expectations, but provides little forward guidance. As expected, the Federal Reserve cut interest rates to a range between 3.75% and 4.00%. The central bank maintained its stance that the U.S. economy continues to expand at a moderate pace and that inflation remains elevated. However, the central bank also continues to highlight a renewed focus on the labor market. Uncertainty about the economic outlook remains elevated. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment rose in recent months, the central bank said in its monetary policy statement, which was relatively unchanged from previous months. Although gold saw some modest volatility in the initial reaction to the Federal Reserve's monetary policy decision, it treaded water just below $4,000 an ounce. Spot gold last traded at $3,987.10 an ounce, up roughly 1% on the day. The monetary policy statement also noted that the central bank has stopped reducing its balance sheet. However, Powell had signaled this move in a speech a few weeks before the meeting. Analysts note that the makeup of the vote could be the most interesting feature of the latest monetary policy meeting. In no surprise, President Donald Trump's central bank nominee, Stephen Moran, voted for a more aggressive 50 basis point rate cut. However, Jeffrey Schmid voted to keep interest rates unchanged. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hype the video, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio and stack efficiently without relying on market commentators. Link in the pinned comment. Let's get back into the episode.
Why is QT about to end? Why is the Fed about to stop shrinking its balance sheet? Because the repo rate, the SOFR, secured overnight financing rate, the rate at which banks get cash for treasuries between themselves, is getting very, very wobbly. You can see here, this is the SOFR. It's supposed to be straight and steady, as it is here in all of these little steps. And he was here in 2021. It was absolutely steady at very near zero. But here it starts getting a little bit more wobbly in 2023, 2024, and then even more wobbly as the Fed rate cuts increase. And this is the most wobbly it has gotten until now. And you can see that comparable wobbliness in this rate occurred in 2019. And here's the apocalypse over here when the rate hit 5.25%. So basically you can see this wobbliness is getting more loud, more pronounced, more extreme, and is eventually going to lead to an apocalypse unless the Fed expands its balance sheet forthwithly. Now we can move to the effective federal funds rate. This is the rate that the Fed is cutting or hiking when it says there is a rate hike or cut. This is that rate. So you can see here, this is the apocalypse going back to 2019. You can see there was a spike here, but it was pretty sudden. And otherwise, it's pretty steady, this rate, as it was here in 2019 after they started expanding their balance sheet again. Pretty steady, only goes up 1 basis point or so, but here it went up a lot. But what is happening now to the EFFR, to the effective federal funds rate? Even that rate is starting to move higher. You can see that face. Look at that face.
Look at this face. Would you look at this face? Is this a face you could die for?
Who couldn't trust a face like that? So you see here that the rate is starting to tick up. It started at 4.08, and I think this is 4.09, and this is 4.1, and here's 4.11, here's 4.12. It's ticking up about a basis point every 2 or 3 days. That is signaling some pretty significant tightness in short-term interest rates because the bank reserves are starting to run out. Here we see that this rate is absolutely steady, didn't move a single basis point until now. The standing repo facility is stupid. Everyone's talking about the standing repo facility and how it's being tapped. Well, it's not really. That's all a bunch of fluff. The standing repo facility is useless because most banks that require cash can't even access it for stupid technical reasons that I don't really quite get. But that is what a bunch of Bloomberg articles have been saying over the past few years, that the standing repo facility is useless because it cannot address cash needs that are actually extant. So here, how do I know that it's useless and stupid? Because here are the repos, the volume of repos that occurred from about 1999, or was it 2000, until 2014 or 15. So we see here that we can see these blue lines. They're pretty active. So they're somewhere between 0 and $100 billion here a day. Here it moves up to about 150 billion or so, maybe 40 billion around 2008 crisis. And you can see here, I think this is the COVID era or something. It skips a bunch of years here because nothing happened. And then you see the big COVID spike to about 250, $260 billion. That was during the lockdowns. And here you see nothing, but here is what the standing repo facility has been doing for the past few days. These tiny little spikes, maybe $7 or $8 billion. And obviously, yes, these were not standing repos. There was no standing repo facility back here in these years from 2000 to 2013, 14, 15, whatever it is. So what does that mean?
In today's news recap, gold poised to soar. LBMA delegates forecast $4,980 per ounce by 2026 amidst historic rally. The global financial community is buzzing with a profoundly bullish outlook for gold as delegates at the London Bullion Market Association's annual gathering in Kyoto on October 28, 2025, have projected the precious metal to reach an astonishing $4,980 per troy ounce within the next 12 months. This bold forecast, representing a significant 27% increase from current levels, underscores a widespread conviction that gold's historic rally is far from over and is set to propel the yellow metal towards the coveted $5,000 mark. The prediction comes amidst an unprecedented surge in precious metals, with gold already experiencing a remarkable 52% year-to-date increase by October 28, 2025, positioning it for its largest annual rise since 1979. Silver, often seen as gold's more volatile counterpart, has also demonstrated exceptional strength, outperforming gold with a staggering 62% year-to-date gain, reaching its highest annual performance since 2010. This dual-pronged rally signals a significant shift in investor sentiment in global financial dynamics as a confluence of macroeconomic and geopolitical factors continues to fuel demand for safe haven assets. The LBMA's forecast of gold hitting $4,980 per ounce by late 2026 is rooted in a comprehensive analysis of prevailing market conditions and anticipated trends. The delegates, representing a broad spectrum of the bullion market, convened at a time when gold has been consistently breaking new ground, defying conventional expectations. As of October 28, 2025, the spot price of gold has been fluctuating around $3,900 to $4,000 per ounce, having recently struggled to maintain the $4,000 level. Now, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. And go to goldsilverstacks.com to get the Numismatics Handbook, the perfect guide for stackers who want to get active trading gold and silver coins instead of selling their gold and silver bullions for fiat. Enjoy the episode.
There was repos. It was day by day. It was on the fly. But really, there's no monetary or economic difference between repos on the fly and a standing repo facility that's operated by some AI or some valve or whatever it is that's making these things go pulling a lever, who knows, who cares? It's all the same thing. Dollars are dollars, repos are repos, whether they're standing or sitting or going to the bathroom, doesn't matter. And you may recall that 2 videos ago, maybe 3 videos ago, something I talked about silver backwardation that wasn't really backwardation, and I stand by that. And I was just saying that there is a spread or an arbitrage going between London and New York, and the special situation in London meant that they were short on silver because for some reason silver was being shipped to New York from London over the past months before, and who knows exactly why. People say it was tariffs or whatever they wanted to say. I'm not so sure. But anyway, we can see that the silver is starting to move from New York back into London. So we had a high here of about 532 million ounces, over 500 million ounces, and now we're down to 492. So that's about 40 million ounces that have been shipped, presumably to London. Probably not all of it went to London, but a lot of it, I'm sure it did. That has alleviated the spread or the backwardation between London silver and New York silver. It's not exactly backwardation because they're not the same products. You have to have the same products at the same place in order for it to be the same products, whereas products that are, chemically the same, meaning silver is silver is silver, but they're in different places, are different goods according to Mises in the theory of money and credit. And so this is not actually backwardation. We can see it was resolved pretty easily by silver moving back to London from New York. And the last slide before we go into an article that goes back into the repo situation and QT, how that is going to end imminently, we can see here that this really is the most pathetic gold correction ever. So what I've illustrated here is the move in gold by trend line from late 2022 at the bottom over here at about 1650 or whatever it was. We drew a first trend line over here from 1650 from 2022 over here to the bottom at 1850 in October of 2023. And then we establish a new trend line that has a higher slope from there until the beginning of 2024. And then a higher slope still from October 2024, this red line over to the end of 2024, the beginning of 2025. And then still a higher slope, meaning acceleration in the gold market from here, from the beginning of 2025 until this is the end of the last correction, the 4-month correction. But it was still a much higher slope than we had seen before, and still an even higher slope from now until the correction that we've seen from the top at 4,400. Are we going to maintain this trend line? I don't know, but I can see here that we're still in a rate of accelerating trend lines. So we're still in a parabolic move. Do I know if it's going to be sustained or we're going to break a trend line? It could go either way here. We'll see.
What do you think of Rafi's take? Do you agree with him? Is this gold and silver correction just a healthy opportunity to buy more, or is the bull run at risk? Post in the comments section your honest opinion and share with the stackers your plan. Now smash the subscribe button and check this video right here because you'll love it, and I'll see you on the other side.